So if an expected return from a business is less than required rate of return of anywhere from 12 to 24%, we do not invest in such company. Even if, let's say we have cash and we don't, if we don't find any investment idea, we sit on cash. Now, this approach, I think, ultimately has worked out because we are under pressure when we have cash in the portfolio to look for ideas. And so we, obviously means that we are, doing our work. And, Indian market, fortunately, is a fertile ground for stock picking. And so opportunities are there to find for those who are looking for them. And I think that is why we have been able to deliver what we have been in terms of, and a median alpha of 9% over 49 rolling 5-year periods that we have completed. Now coming to the Indian market outlook and what sort of long-term return one can think about. I mean, there's no, I don't have a very, very complicated framework for that. All I can say is, our economy is likely to do 6 to 7% real GDP growth, let's say, and you add 3-4% inflation on average, in a reasonable government environment, then we end up with 10 to 11% nominal GDP growth. The listed corporates have, I think, have the potential and have historically grown at a faster rate than that in terms of earnings growth. So I think low teens to maybe a little bit higher kind of a market returns can be expected, and hopefully we strive to do better than that. And our investing approach has yielded results which are better than that, much better than that.